Mr. Jain, who's joining us.
No, Rajdeep, I also want to point out, I mean, while we are talking about the social sector, one very key number in the budget always is the gross market borrowing for this government for the next year. And that has been pegged at 14.95 lakh crores, if I'm not mistaken. Now, that is way above what the market's expectation of 13 lakh crores was. And at this point, it would be useful to see what the bond is doing, the benchmark bond, because I think bond yields would have gone up on the basis of this development. The fact that the gross government borrowing actually calendar is much ahead of what the street was penciling in. And this is a key threat to this year's economic progress in 2022. If bond yields continue to rise, because inflation is already quite elevated, and you have a gross market borrowing from the government which is also higher than expectations, then you can create an interest rate system which is quite elevated, and that might be growth impeding. So on one hand, you're trying to stimulate growth on CAPEX, but on the other hand, if your actions and borrowing lead to some kind of hardening of bond yields in the system, that might come in the way. I think one needs to be a bit wary about that. And if you say Nirmal Jain has joined in, maybe that could be my first question to him. Nirmal, if you can hear me, have you taken a look at the gross market borrowing from the government, and is it higher than expectations? Is it leading to any kind of hardening in the bond yield today?
No, it's definitely higher than expectation, but there was always a trade-off. And because this year, I mean, of course, on the lower base of last year, we got 9.2% GDP growth. So either you maintain the momentum, and which also has positive impact on jobs and a cascading impact on other sectors. So I would go with this, that at any point in time, any finance minister will always have a trade-off, either to give support to growth or worry about inflation. But given the fact that bond yields have been still in a comfortable range, so if you go back to say earlier crisis of 2008 or even earlier in the taper tantrum of 2011, bond yields were hovering at a much higher level, around 8%. So by that yardstick, I think the finance minister would have been in a zone where probably she could have taken some chance with the bond yield. And I have a feeling that if this year they did a lot of groundwork on disinvestment, but they could not achieve the target. And a lot of this disinvestment will get pushed to the next year, which will give leeway to the government to make sure that the bond purchases or borrowings or inflation, they don't go out of control. From that perspective, I think there's always, and what market was expecting, most of the economists probably would have supported this as well, that we are coming out of pandemic. And the last thing that you want to do is that slow down the growth momentum, given that exports are going for it. Exports are growing at a very reasonable pace. The tax buoyancy is very good. In fact, the CAPEX increase of almost 35% is way above anybody's expectation. So the government's intention is very clear, that they want to pump prime the economy with a lot of support to CAPEX and make sure that there's a cascading impact on the jobs and income levels.
Okay. Ashok Wadhwa of Ambit has also joined in, and he is a veteran of many